Okay, so today we are, we'll deal with some, about the surcharge, about the personal taxation, COVID-19 relief, the crypto tax, which is the hot topic for, of this particular finance bill. Then the amendments, retrospective amendments, which Ketan Bhai spoke about. Then the section 68, the source of source, which Ketan Bhai mentioned. Then about on the procedural aspects, return of income, very interesting development, updated return, which has been introduced this year, a new concept. So let's see how it will play out, what all it involves. Then the faceless assessment, I think all of us are familiar, but we look at what are the, it would, from the bill, it would seem that the entire chapter has been replaced, but what are the changes on that, faceless assessment, we will just focus. New reassessment regime, we had a totally new reassessment regime introduced last year. So what are the changes made this year? How far they are in keeping with what was told to us last year on objectivity, transparency, certainty, objectives which are spelled out last year. How do they hold up against the current year's amendment? We will just see. And the TDS, TCS related some of the amendments. Okay, we'll start with the first item, which is the reduction in surcharge. This year, there has been no changes in the tax rates. Only for one limited change is the reduction in the surcharge. So surcharge either to, and this is applicable only to an individual, HUF, AOP, BOI, or AGP, the first category of the taxpayers whom you find in the, the part A or, the part 1 of the, your first schedule of the Finance Act. So in that, the surcharge presently was capped at 15% for certain incomes. For residents and foreign portfolio investors, it was capped at 15% for dividends, short-term capital gains under 111A and long-term capital gains under 112A. Basically, these are all capital market instruments, equity shares, equity-oriented mutual funds, REIT InvIT units. For non-residents, it was capped at 15% for 111A and 112A. For all other items, the search on the capital gains, the surcharge was up to 37%. So a person whose total income is more than 2 crore and up to 5 crore had to pay 25% surcharge, and above 5 crore he had to pay 37% surcharge. So the highest effective tax rates for short-term capital gains would have been 42.74 or 28.5% for the long-term capital gains with the base rate of 20%. Now, what the finance bill proposes to do is to cap the surcharge under section 112 for both residents and non-residents to 15%. So it's an across the board reduction for all the residents and non-residents on all types of assets except one. So the highest effective tax rate after this reduction would now be 23.92% instead of 28.5%. So there's a substantial saving, around 4.5% reduction. Of course, for the very high income earner who is earning more than 5 crore rupees. It applies to all types of assets which fall under 112, which is real estate property, unlisted shares, debt-oriented mutual funds, debentures, compulsorily convertible debentures, and all for both residents as well as non-residents. However, one exception to this is the virtual digital assets, which we will discuss in some time. That will be taxed at 30% plus applicable surcharge, which can go up to 37%, even if the income is in the nature of long-term capital gains. Also, there is no change in the short-term capital gains, where the surcharge will remain 37% for incomes above 5 crore. Next slide, please. Next, on the personal taxation for individuals who are impacted because of COVID-19, in June 21 and 25th June 2021, after a lot of clamor from the industry, the government came out with a press release and they announced certain relief for the, one is basically the medical expenses reimbursement, COVID treatment, medical expense reimbursement, which people were receiving from employers or from other persons. And the second was after the unfortunate death of any individual, if any ex gratia was paid by the employer or other persons. So an exemption was announced, and that is being codified and in the present budget. But at the time of, codification or enactment, you can always expect there is always a slip between the cup and the lip. So there are certain new things, new conditions which are added. So in this slide, you will see those new conditions have been highlighted by bold. So if you have section 17.2, which defines perquisite, there is a proviso which provides for a carve out or the exemptions of certain items from the perquisite. So there you have a new addition of an item, which is the COVID-related medical expenditure, which is reimbursed by the employer. However, it is not a blanket exemption. it will be exemption will be subject to certain conditions to be notified by the central government, and this will have to wait until the finance bill is enacted for the government to notify those conditions. Next is gift taxation under 56(2)(10), because there was an apprehension whether this COVID-19 relief will result in a gift taxation in the hands of the individuals. So we have an amendment, as was announced earlier, that if you are receiving reimbursement of COVID-19 medical expenses, or you are receiving ex gratia, then for as far as medical expenses is concerned, it will be exempt without any limit. However, at the the finance bill says this exemption will also be subject to the conditions to be notified by the central government. There is no quantum threshold for this exemption. As far as ex gratia is concerned, if it is received from the employer of the deceased employee, then there is no limit. It will be exempt without any limit. But if it is received from any other person, then the total aggregate exemption will be restricted to rupees 10 lakhs. Now, one more added condition which is added is that this ex gratia will be exempt if it is received within 12 months from the death of the individual, and further subject to some other conditions which will be notified by the central government, for which we will need to wait till the bill is enacted and the government comes out with the notification. Now here the ex gratia is received by the family members, so therefore the term family is also defined. Now here the definition of family is borrowed from section 10 subsection 5, which deals with LTA exemption, which covers only close family members, which is the spouse, children, dependent parents, and the siblings. Next slide, please. So if we see, as compared to what was announced earlier and what has been actually enacted, the two main differences are that for ex gratia, there is a condition that it should be received within 12 months of the death of that particular person. Now this creates an ambiguity because a lot of employers, as a part of their good HR policies, they had announced benefits traveling beyond 12 months. For example, some companies had said that they will continue paying the salary for the next 2-3 years, or some companies had said we will continue paying salary till the normal date of superannuation of that employee. Some companies have said we will meet the cost of education of the children till they reach graduation or something like that. So there were many benefits which the companies had announced which were to go beyond 12 months. So there this will, whether this exemption will apply and how will this play out is something which we need to see. Second is the conditions to be notified by the central government for both the medical assistance and the ex gratia. So what are those conditions? Today we are not aware, but based on our discussions with the CBDT officials, what we understand is that these will not be onerous. So it will not be very difficult to comply with them. Now, because one good thing is that they are bringing in an amendment with a retrospective effect from assessment year 2021, which is starting from the year 1920, when this if you see in the last fortnight of March, this COVID problem arose. So they are bringing in that amendment from 2021, which is to the benefit of the taxpayer, unlike the other retrospective amendments. But practically, this majority of the payments would have been made during assessment year 21-22. Now, why these 12 months would have been put? What we feel is possibly because to avoid any abuse of that relief through non-genuine transactions. Because this exemption is given for a good cause. It can be abused by some elements, because somebody may pay the COVID relief after 2 years and 3 years just to convert the black money into white. So therefore, to avoid such kind of abusive transactions, a rationale of limit of 12 months is introduced. One factor which can cause some concern is that this relief should be, this ex gratia payment should be received in relation to death due to illness related to COVID-19. So it is not directly, it is illness related to COVID-19, and we see that in many cases what has actually happened is that the people might have recovered from COVID, but they might have died due to some other comorbidities which got accelerated due to COVID-19. So how in those cases this relief will be granted is something which we need to see. As I mentioned earlier, the definition of family is restrictive. It may not cover all close relations. For example, daughter-in-law or somebody receives it, it will, this exemption will not apply. It is effective retrospective from assessment year 2021. But majority, what I feel is practically majority of these announcements, etc., had come during assessment year 21-22, when the first wave and the second wave had peaked. So here now there will be, of course, we are told that these conditions to be brought in will not be very onerous. They would be aligned with what the central government itself lays down for the purpose of paying the ex gratia to the general public, which is at 50,000 rupees, which the central government itself is paying, in order to ensure that there is complete alignment, there is no abuse. But let's assume, hypothetically, if those conditions, some of these conditions are not met, then there some further issues can arise. That, for example, if it's for assessment year 21-22, some reliefs have, some amounts have already been paid. And if those don't qualify those conditions, whether the employer will need to do a catch-up TDS for the salary TDS. Now, if something is getting taxable under 56 to 10 as a gift taxation, obviously the employer has no TDS obligation because it's coming under income from other sources and not as a salary income. Next, what Praful Bhai will take, discuss about the updated return. So we have to seek if something becomes taxable, whether this new window of updated return can be availed in order to, pay the taxes. Or in this kind of cases, you may also find that if it is going to be taxable, in some cases, some recipients may say, we don't want this money, please take it back. Or some employers may feel that, okay, we have to do something to avoid this, unintended taxation. So, they can give a loan, take back the money, give some relief in some other manner or something like that. So, if those conditions are very onerous, some creative thinking, etc., might come from some of the, in some cases. Next slide, please. Okay, so now we come to the crypto tax. For the purposes of taxation, it is known as virtual digital assets, not a crypto asset. The technical term for the income tax purpose, at least it will be virtual digital assets. Whether the same concept will now be taken for other taxation and regulatory laws is something to be seen. All of us are aware that for crypto, there is no regulations as of now. And that is, the subject matter of debate and, consultations which the government is doing with the stakeholders. They are, considering, either banning on one hand what RBI is recommending or putting in place some regulations for the protection of the stakeholders, for the protection of the market and an orderly development of the market, just like you have a SEBI for securities or for insurance, you have IRDA and like that. So what they have presently done is that, the easiest thing is to impose a tax, so that they have imposed a tax on the transfer from VDS. As I said, it's not a new tax. Even without this provision, I think people were fairly clear that if you earn any income from these crypto transactions, it is taxable. The questions around was what was the characterization, what is the rate, loss, how will it carry forward, loss, how it will be set off. All those questions were arising. So some of those questions are sought to be addressed through the amendments made in the current finance bill. So these amendments can be put into 4 different buckets. The first is the definition of the virtual digital asset. Now it is defined exhaustively, and we look at the definition a little more closely, but rather at a conceptual level, as because how it can be applied in practice is something which needs to be seen, and for which you may need to have a separate session totally dedicated, only for discussing the crypto taxation. It also includes one more type of this crypto asset, which is called non-fungible tokens, and some other digital assets which may be notified by the government. Now, very interestingly, this provision is effective from 1st April 22, which is assessment year 22-23. Okay, so you may wonder whether it is meant to be retrospective, but there is a specific reason which I will just come to. The next is the rate of tax, which is now specified. There is a new section 115 BBH, which provides for a 30% tax rate for income from transfer of VDA. So it's only from a transfer of VDA, not earning VDA. So it's only when you have a VDA and you are transferring it, that time this tax rate will become applicable. And it not only provides for a rate of tax, it also deals with certain computational aspects. It provides certain restrictions, which we'll just see in some time. Now, this provision, which provides for a special tax rate of 30%, is applicable from 1st April 23, so it's effective from assessment year 23-24 onwards. So it will apply for income which arises from transfer happening on or after 1st of April 2022. So if you are doing a transfer up to 31st of March 22, you are governed by the existing law, where this 30% tax rate is not there. It will be the normal tax rates. Whereas if the transfer is happening after 31st of March 22, the income, the tax rate will be governed by this new section 115 BBH. The third bucket is a TDS. So there is a 30% tax rate, but on the TDS there is only 1% TDS which is put, and it is more meant for a tracking mechanism, just so that the government gets a the information of what are the transactions in crypto assets happening across. However, this TDS is restricted to payments to the residents. So you will wonder what happens to the non-residents, because non-residents are already covered by another TDS provision, which is 195, which is a very generic and covers all incomes of non-residents. So there is no separate TDS provision for non-residents. However, there the TDS will be at 30%, because if you see under 195, you have to deduct tax at the rates in force, and the rates in force as per the domestic law will be 30%. Then you have to compare it with the treaty rates and see whether any treaty exemption is available or a lower rate of tax is provided in the treaty. However, for payments to residents, the TDS rate will be 1%, and this provision is coming into effect from 1st of July 22. So now this is the reason this provision is becoming immediately applicable. And if there is no definition of a virtual digital asset, how will you implement the TDS? So for that reason, we are having the definition of VDA is being put into effect from assessment year 22-23. The last bucket is the gift taxation, which is if you receive VDAs without consideration or for inadequate consideration. Now the scope of 56(2)(10) is being widened. The proper, in addition to the money or specified property, now even virtual digital asset is also added within the scope of 56(2)(10). And this provision is also effective from 1st of April 23, which is assessment year 23-24. So if you are making a gift up to 31st of March 22, it is not covered within 56(2)(10). But if a gift is made from 1st of April 22 onwards, then the recipient may face a gift taxation under 56(2)(10). So now this is the broad 4 buckets. Now let us get into the specifics of each bucket. So the first is the definition of virtual digital asset. Now it's a little long definition. So for the purpose of better understanding, what I have tried to do is put it into a table and split it up. So, you can divide it for the sake of discussion, and for better understanding, you can divide it into 3 categories. Now, the first category is what I call as a crypto asset. It's not a term which is used in the definition, but the definition, the first category of the assets, which we generally call as crypto asset, what we generally in commercial parlance and everyone when he speaks about calls it as a crypto asset, be it Bitcoin, Ethereum, stable coin, whatever like that. The second is the non-fungible token. Non-fungible token is a separate asset class because its value is derived from the underlying item. So which is a sort of a digital item, which could be a collection of poems. It could be, Jack the first tweet by the person who invented Twitter or anything. So any memorabilia which is in the digital form, so you can have a non-fungible token attached to it. So and everything works on the blockchain technology. There is authentication, approval, validation procedure. So it's only it's one of its kind. It's very unique. So this is the second asset class under this virtual digital asset. And the third is any other category, which is the residual category. So we start with the first one, which is the crypto asset, what we call. Now, for that, you have one basic condition, and there are 2 additional conditions. And the requirement is you should fulfill all the 3 conditions. So these conditions are cumulative. But on the first condition, you have an alternative, either or. Otherwise, you should fulfill all the 3 conditions. Even if one condition fails, then you are out of the crypto asset definition. However, the language of the definition is very wide. So first, the basic condition reads any information or code or number or token not being Indian currency or foreign currency generated through cryptographic means or otherwise by whatever name called. So it should be something which is generated through cryptography. It should not be Indian currency or a foreign currency. But the requirement or otherwise, that creates a twist in the tail. It says it need not be created through cryptographic means. So now you may ask a question, why the government has done, kept the definition so wide. So we have to also empathize with the person who was drafting these provisions, that this field is such a vast and disruptive field new things, new types of assets keep in coming in day in and day out. You never heard about, so for example, Chingari, the crypto asset a few weeks back, but now it is there in the market. You may hear every day some new products might come into the market. So how does the government ensure that through a definition, all such assets are getting captured within the scope of VDA? For that, they had to keep it very wide. But if there are concerns, yes, it can be discussed with the government, and the government has kept the power. Next is the first additional condition, which, as I said, they are alternative conditions. The first is providing a digital representation of value exchanged with or without consideration, with the promise or representation of having an inherent value. So the key point over here is a digital representation. It should not be physical representation, something which you cannot feel and touch, something which you cannot smell or hear. You can only see in your computer screen, on your laptop or something like that. It's a digital thing. It's not a physical thing. Second is, or the alternative condition is, functions as a store of value or unit of account, including its use in any financial transaction or investment, but not limited to investment scheme. So it could be, there is one called as a stable coin, where the value is tagged to the US dollar. So its value is always linked to the US dollar. So you can always store it as a unit of account for doing transactions, etc. So it should either function as a store of value or a unit of account. One of the two conditions has to be fulfilled of both of them. If it fulfills both, nothing like it. If it does not fulfill any of the two, then you're out of VDA. And the last condition is also very important. Condition number 2 can be transferred, stored, or traded electronically. So it should be capable of being transferred, or it should be capable of being stored, or it should be capable of being traded electronically. Now the key thing over here is or, and that is creating some concern. It's not and. So if it can be transferred electronically, then very technically, very clinically, even if it cannot be stored or traded, it still fulfills the definition. It is within the scope of the definition. So that is one area of concern which we may have. Next two items are very easy: non-fungible token and residual asset, because here the government has to do some positive action. So non-fungible token is a digital asset, as the central government may by notification in the official gazette specify, or any other token of similar nature by whatever name called. So it is a digital asset, but the digital asset should be one which is notified by the government. Once a particular digital asset is notified as a non-fungible token by the government, then that particular asset or any other token of a similar nature will get captured within this definition. But here again, central government has to notify, otherwise this part of the definition will not be in operation. Third is any other digital asset, as the central government may by notification in the official gazette specify. So anything else, government feels that some new products have come into the market which are not capable of being fitting within crypto asset or in the non-fungible token, then it may just notify it as a virtual digital asset. And the last part is the exclusion. Here the central government has taken the power to notify in the official gazette any digital asset from the definition of VDA, but subject to certain conditions as may be specified there. So as we will discuss, in a little while, credit card points, loyalty points, etc. If there is a huge concern that, this fits within the definition of crypto asset, and the government feels it is necessary to clarify or to, remove all the confusion, it can as well notify in the official gazette these particular type of assets subject to these conditions are not virtual digital assets. So that power has been retained by the central government. So wherever there is a huge confusion about a particular asset getting within the scope of VDA, and it can create disruption, yes, the industry is free to engage with the government and point it out. And if the government is convinced, it can by notification exclude it. Next slide, please. Okay, now we're coming to some of the issues. Of course, there will be a lot of issues, but let me take touch only on some of the issues on this. As Ketan bhai first, identified whether it covers credit card loyalty points, in-app points, air miles, etc. If we look at a very clinical definition, how an assessing officer would interpret it, he would say that it is an information token. If it is not generated through cryptography, doesn't matter. It is a digital representation of value. You cannot feel, touch it, and it can be either be transferred. It can be stored. electronically. So therefore it fits within all these points, fits within it. Of course, all of would agree that the provision has not been brought about to capture these kind of assets which are already there. These are basically discounting feature. I mean, discounts for you get a savings in the expenditure. These are not independent items of trade or commerce in the market. And whereas it is very clearly brought out in the explanatory memorandum by the budget speech that what they had in focus was the basically the crypto assets like bitcoins, ethereums, etc., which are presently traded in different crypto exchanges. However, if there is a concern, yes, we can make representations to the government to clarify it, and they can clarify it. Now, one small point is about digital asset. The definition uses digital asset in two limbs, the second NFT limb and the third residual category, and even in the exclusion. In the first category, it is not mentioned. But digital asset per se is not defined. So it's only the virtual digital asset. The definition says virtual digital asset means 1, 2, 3. But what is digital asset is not defined anywhere. Even for the exclusion talks about digital asset. So the exclusion very clinically could be from the scope of non-fungible tokens or the third, the residual category. Now, the exclusion may not apply to the first category of crypto assets. If we read very, very too much into the lines, one has to see how the government interprets that particular exclusion criteria. The third is the finance minister also spoke about, introducing a RBI's own digital currency sometime during the year. Now we have to wait and watch, whether it will get excluded from the virtual digital asset either as an Indian currency or they may exclude it from notification, because of course the government will not intend to tax this at 30%. The next point is that this virtual digital asset is an independent standalone definition on section 247A. The definition of capital asset is not defined, changed. So, there could be some suggestion that, the VDA is not a capital asset, but I would believe that may not be the correct interpretation, because the definition of capital asset under section 214 is very wide, because it includes property of any kind, and there are only a few exceptions like stock in trade or personal effects per se. Now, this personal effect, whether this VDAs will fall within personal effects is little debatable. But of course, that will be, even if it is a personal effect, it may not fall under the capital gains chapter. But whether, because it can 30% tax rate can apply or not is something, whether there has been a miss is something which we need to see. The last point is, the one question which is bothering is whether this VDA is an intangible asset. So suppose you are not in the activity of buying and selling, but if you are a new stream of activity which is coming around is lending of VDAs. Because we know that the income from transfer of VDAs is liable to tax at 30%. So people might change the business model and say, instead of buying and selling, we may do lending and borrowing. So if now in that particular case, whether this VDA will become an intangible asset and whether it can qualify for depreciation, again, we have to think about it. It will be a little controversial issue. Next slide, please. So we come to the second bucket, which is the special rate of tax of 30% on the transfer of the VDA. Now here the section 115 BBH starts with that if your total income includes any income from transfer of VDA. So total income is computed first, and then you find out whether it includes any income from transfer of VDA. Now transfer is not defined in that particular section 115 BBH. So if you try to search where this transfer is used, you have in 247, but in section 247 the definition applies only to a capital asset. However, 115 BBH is not restricted to capital assets. It applies to both capital asset as well as stock in trade. Next is it provides for a rate of tax which is 30%, and the 30% will have to be added with the applicable surcharge and cess. The effective tax rate can be as high as 42.74%. The next is the computation part, and the computation part provides now two limitations. So what it says is, notwithstanding anything contained in any other provision of the Act, first is no deduction in respect of any expenditure other than cost of acquisition or allowance or set off of any loss under any provision in computing the income from transfer of VDA will be allowed. So except for cost of acquisition, no deduction for any expenditure, allowance, loss, etc. will be allowed to be set off against the income from transfer of VDA. So it is the gross sale consideration minus the cost of acquisition. Next is, there is no set-off of loss from transfer of VDA shall be allowed against income computed under any other provision, and such loss shall not be allowed to be carried forward to the succeeding assessment years. So if there is income, if there is gain, you pay 30% tax, but if there is loss, you will not be able to set it off against any other asset. Whether it can be set off against the income from VDA itself is something, is again a little debatable issue. Cost of acquisition. Now it refers to cost of acquisition, but as we know, the scope of asset which is covered is both capital asset and stock in trade, whereas cost of acquisition definition you find in the capital gains chapter in section 55(2), which applies only to a capital asset. So then if it is you are transferring VDAs held as stock in trade, whether the cost of acquisition is to be computed in general accounting principles, and whether you can bring in now here ICDS 2, which deals with valuation of inventories and provides for how you will what all costs you can include in the cost of inventories, is something which needs to be seen. Possibly, it will need to be computed as per the commercial accounting principles, and one may be able to take guidance from ICDS 2 also. The next is that you may have acquired that VDAs in different tranches and at different costs. So then how do you compute that cost? For the shares which are holding in demat account, there is a specific provision 45(2)(a), which mandates that this cost should be computed on FIFO basis. But here, if you are having these virtual digital assets in your wallet, then whether you will compute the cost on FIFO basis, LIFO basis, or weighted average is something which is not clear. That we'll need to find out, as we say, if we see a little further. Now, if you see on this 30% tax rate, without any deduction for expenditure, without any set-off of losses, it will appear to be very strict as compared to some of the other, items which are liable to tax at 30%, which is say lottery winnings or speculative loss. Now, speculative loss, in fact, you can carry it forward for 4 years, but this loss from VDA, it cannot be set off or carried forward. This 30% tax rate, some of the issues which can arise, this is applicable both to residents as well as non-residents. But for non-residents, there will be certain complication for applying this tax rate, because we don't have a situs rule. Where is this VDA located? It is always difficult because it is somewhere in the internet. You don't know, it is in blockchain, technology, somewhere in decentralized ledger. So you really don't know whose laptop, which server is this sitting. So finding out its situs is very difficult. So therefore, how will you tax on non-residents unless you have certain rules which will say that a VDA which is dealt with in Indian crypto exchange will be considered as located in India, and therefore it will trigger taxation for the non-resident. Unless if you have such kind of a situs rules, how this will be applied to non-residents is a gray area. Now, so long as treaties are there, the treaties may also protect the non-residents from any taxation of business income if they don't have any PE in India. Of course, this is subject to the Pillar 1 implementation and having a global rules for taxation of the profits arising from the digital transactions. Third is, when you're dealing with the non-resident, you always have a vicarious liability. If the non-resident earns any income and if proper TDS is not deducted, then the person through whom that non-resident earns income can be pulled in, can be roped in by the tax department. So when you are dealing with non-residents for VDAs, this is another risk which the taxpayers or the residents will face. The next is barter transactions. So in VDAs, you can have exchange of one VDA with another VDA, one crypto asset for another crypto asset. You can also have the feature where you are availing the services, and for the compensation for those services are paid in terms of VDAs. So in both the cases, there is a barter transactions. Now this 115 BBH applies for income from transfer of VDA. So whoever is transferring the VDA, he will have to pay 30% tax. And the other person who is receiving it, for him, we have to see the gift taxation. And for him, it could be either the gift taxation or it could be normal income also. But if there is a one person A and another person B, one is holding Bitcoin, another is holding Ethereum, and they are exchanging Bitcoins with Ethereums, then this 30% tax rate will apply to both of them, both the people, because both of them are having an income from transfer of VDA. If you are paying, if there is let's say the crypto exchange is there, it is paying some of its employees in kind in terms of Bitcoins. Then for the crypto exchange, there is a transfer of VDA. And for the employees who receive this Bitcoins, it is a normal income. They are not having income from transfer, but they are getting income in the form of VDAs. So they are not liable to tax at gross rate of 30%. They'll be liable to tax at normal rate. But for the crypto exchange, for the payer, there is an income from transfer which will be liable to tax at 30% on the sale price minus cost of acquisition. Next is, as we started, this 115 BBH starts with where the total income includes income from transfer of VDA. So now total income is the final result after you have availed exemption under certain provisions or claimed deduction under certain provisions. Now the 194S, which is now 115 BBH, says that you will not get any deduction for the expenses, etc. No set off of losses will be possible. But there is no mention of exemption under 54F or Chapter 6A deduction. There is no limitation, there is no restriction, but we'll have to wait until the final bill is enacted, whether these types of exemptions can also be roped in for the limitation. Next is a issue which is again not a very clear answer, is whether if you have a loss on one VDA and a gain on another VDA, whether it can be set off against each other, because they are not the set off is not against loss arising under any other provision. It is under 115 BBH itself. If there is a net loss, yes, it cannot be carried forward. But during the year itself, if you have loss from one VDA and a gain on another VDA, whether you can set it off is something which needs to be seen. No clear answer on this. The last point on this is the losses which are incurred till assessment year 2020. When this section is not there, it is firmly believed that it can be carried forward and set off under the normal provisions. It is only the income from transfer which is arising on or after 1st of April 22, which will be governed by this special 30% tax rate. Next slide, please. Okay, the third bucket is 194S, which is the TDS provision, which is closely linked with the income, 115 BBH that we just discussed in the earlier slides. Now here the effective date is 1st of July 22, and I also explained you the background. The definition of VDA is brought in with effect from 1st April 22, just to give effect to this provisions. On which transaction this TDS will apply? It will apply on a payment on transfer of VDA. Who should be the payee? The resident. And I also explained why the non-residents will be covered by the 195. Who has to be the payer? Now the payer could be a resident or a non-resident, anybody. However, what is generally understood as the legal position is that if a payer is a non-resident, the non-resident generally do not have any obligation to withhold taxes unless they have some taxable presence in India, and only in certain situations like 195 that there is a specific amendment to cover the non-residents for the purpose of TDS obligation. Otherwise, they are normally not liable for any procedural obligations in India. So if there is a non-resident who is having a branch in India, now he will definitely be liable to do this TDS. But if some non-resident is outside, he is not having any taxable presence in India, then arguably he will not have this TDS obligation when he is making payment to a resident. And that position has been accepted in case of even 194Q, which is a TDS on purchase of goods. The rate of TDS is 1%. It is just like 194O e-commerce transaction, and it is to be applied on the consideration for transfer of VDA. 1% is not to be increased by surcharge or cess like any other domestic TDS provision. The timing of the TDS, it is normal payment or credit, whichever is earlier. And the credit also includes a credit to the suspense or any other account. This is a typical feature of all the TDS provisions. Here, the law recognizes that there could be payments in kind. So VDS could be exchanged, and there could be barter transactions. So therefore, they are providing, just like lottery winnings, that if there is an in-kind payment, then the payer has to ensure that the tax is paid before the consideration is released to the payee. So it is very similar to lottery winning. So you have to somehow ensure that the tax is paid before you actually, hand over before you actually release the consideration for the transfer. Next slide, please. There are certain relaxations, concessions given to the small taxpayer. Otherwise, the small taxpayer, like salaried person, is also covered by this TDS. He is also required to do TDS, but there are certain concessions which are given. So the first is, for defining this small taxpayer, the concept is a specified person, and specified person is defined to mean an individual or HUF who fulfills one of the two conditions. Either his sales turnover gross receipts in business is less than 1 crore, or his gross receipts in profession is less than 50 lakh in the preceding financial year, or a person who has no income under the head business of profits and gains of business or profession. So very a salaried person may not have any income under the business head, so he will be a specified person. What is the threshold limit for doing TDS? If it's a specified person is the payer, which is like salaried person, small businessman, then he need not do TDS up to 50,000 rupees. But if the value of the consideration exceeds 50,000 rupees, either individually or on cumulative basis, qua a particular recipient, then he has to do TDS. For all others, it's a very low threshold of 10,000 rupees. Then two other relaxations which are given to the small taxpayers, which is the specified person, is the salaried person who is doing TDS, he need not obtain 10. So it is just like the TDS on immovable property, where you can file a single challan cum statement. So he doesn't have to take a 10. So there will be no quarterly TDS returns also. Then another relaxation which is given is this TDS is exempted from TDS at a higher rate under 206 AB, where payee has not filed the income tax return. So if an individual salaried individual is doing the TDS, then he need not check whether the payee has filed a return, whether he is a specified person under 206 AB or not. Incidentally, where the 2 years condition, 2 years failure to file returns is being reduced to 1 year under 206 AB. The next is the feature which is now very common for a lot of TDS provisions which have been introduced recently, last 2 years, the power to remove difficulty through the guidelines. So we have seen this for e-commerce transactions under 194O, we have seen this for 206C1H, we have seen this for 194Q, and now we have this for even for TDS under 194S. The clarifications, if the government is doing clarifications on resolving the practical difficulties, it is most welcome. But one bad feature, what you can call, of these guidelines is it is specifically mentioned in the law that they will be placed before both the houses of parliament, and then it will be binding on both the tax authorities and the payer or the buyer of the VDA. So it has a sort of a status which is superior than the normal civility circular which is issued under 119. But however, wherever the industry or stakeholders have any problem, they can of course make representations, and if the government is convinced, they can remove the difficulty through a circular. Next is the interplay with other TDS provision. If there is a competition between two TDS provisions, how will it will? So what is provided is, first is that if tax is deducted under this TDS provision at 1% under 194S, then it will override any other TDS or TCS for the payer or the buyer. So if the buyer, if say for example, buyer has to see whether it will fall under 194Q or 194S. So, under it is a purchase of, suppose VDA is taken as a purchase of goods. So 194Q is also fulfilled, 194S is also fulfilled. Then he has to do TDS under 194S. Then all other TDS provisions are exempted, or even TCS provisions are also exempted on the same transaction. Here the condition is if tax is deducted. So this very, you can compare it with the language of 206C1H, which says where tax is liable to be deducted and deducted, then there is an exemption under from TCS. Okay, but here it says only if tax is deducted under this section on that transaction, then no other TDS or TCS will be applicable. The last point is about if for the crypto exchange. So if the crypto exchange has to do 194O, and this transaction is also falling under 194S for the e-commerce operator, then 194S will prevail as such. Okay, we move to the next slide. Now these are the issues which will arise under this TDS, new TDS. There will be a lot of practical challenges, but I have just tried to capture some of them. First is, common difficulty for all exchange-based transactions, where there is a difficulty of identifying the buyer and the seller. There is no one-to-one relationship possible. Now here, in this kind of transactions, if the buyer does not know the identity of the seller, how can he do the TDS? For 194Q as well as 206C1H, through the circulars, an exemption has been granted for the transactions happening through the recognized stock exchanges. But here we have to wait and see how it will play out. Because if you say most of the majority of the transactions are happening through crypto exchanges only in India. So if you say those transactions are out of TDS, then possibly, the TDS may not apply it, the whole purpose may get defeated. So then possibly the government might clarify that it is a crypto exchange who knows the seller. So even the buyer and the seller, buyer may not the seller, but the crypto exchange is making payment to the seller, and therefore it is liable to do TDS. But then what is provided in the law is if there is a competition between 194S and 194O, then 194S will apply, and 194S applies to the person who is responsible for paying this amount. So the crypto exchange may as well say that I am an intermediary, so I am not responsible. So we have to wait and watch how this plays out and how the transactions through crypto exchanges will be brought under TDS. Most likely it is that the crypto exchanges will be asked to do TDS. The next limb is about difficulties in barter transactions. As I said, there could be two types of barter transactions. One is VDA to VDA, or another is you are availing services and paying in VDAs. Now the main question there will be, how will you value those transactions for the purpose of doing TDS? Unless you know the value, how will you deduct tax? And if it's a barter transaction, one VDA with another VDA, which happens instantaneously on the app or through the crypto exchange, how can you ensure the TDS payment is made before the release of the consideration? So that is one practical difficulty which will be encountered. Third is, there is no TDS exemption for the transferor for the payments for services in VDAs. So for example, if a crypto exchange is paying salary in Bitcoins to its employees, then in that case, the crypto exchange remains responsible for doing TDS under 192. And the salaried person will have to do TDS under 194S. Next is the default in the TDS. You have one apart from the interest, penalty, etc. There is also a disallowance under 40A1A, which will now apply for computing the business income other than to transfer of VDA. Because if it's an income from transfer of VDA, then no deduction, no expense, etc. is allowable. Only the cost of acquisition is allowed to be deducted. Next is, if there is a gift by a resident, then then arguably there is no consideration, and therefore there is no TDS requirement. Next, as I said, the new stream of activity which is now developing, which is the borrowing and the lending of VDAs. Now, in that case, if there is no transfer of VDA, it is only lent or borrowed, the questions may arise whether I-194S will apply or not. Apparently, it may not apply, but we have to wait and watch how the government reacts to that suggestion. Now, in this case, let's say person who is lending the VDAs, he receives compensation in VDAs. Okay, so I have lent 100 Bitcoins for, let's say, 2 months, and against that I get a return of, say, another 2 Bitcoins. I get 102 Bitcoins. Then the question will be whether this is royalty, which is whether it is interest, etc., and how the 194S will apply on that particular transaction. Okay, we move to the next slide. The last bucket, we come to the last bucket, which is the gift taxation of VDAs. So here, the definition of property has been expanded to include the VDAs, whether it will cover, for other properties, it is covered only if it's a capital asset. Here, whether it's a capital asset or stock in trade, both it will be covered. Rule 11 UA may be amended in due course to prescribe the valuation for this type of an asset. And once that is being done, therefore any receipt from any person without consideration or for inadequate consideration will be liable to tax as income from other sources. There is no amendment in the exclusion part, so therefore existing exclusions which apply for other assets will continue to apply. For example, if you receive these VDAs through inheritance or as a marriage gift or from your relatives, it will not be taxed. Income, which is the gift taxation, is not covered by 115 BBH. You are receiving it, you are not transferring it, so therefore 30% tax rate will not apply. It is a normal tax rates which will apply. If you are receiving it or receiving a VDA, then, and if there is a gift taxation which get triggered, then for a capital asset there is a cost step up to that extent under section 49(4). So we have to see how it will apply in this particular case. If you are being VDAs are received as a stock in trade and there is a gift taxation or a perquisite taxation, then how it the cost will be allowed for the further deduction or for the further transfer. Non-residents, I already mentioned. For non-residents, if they are receiving gifts, in absence of citus rules, it will be very difficult to say how they will be taxed on these gifts. But if there is a taxation, etc., is there, then the payer also has a corresponding TDS obligation under 195, and there is a Form 15 CACB reporting also applicable. How far, if the transactions are only this transfer of VDAs and there is no bank remittance involved, how will you do this Form 15 CACB reporting, etc., is a question which needs to be seen practically. this gift taxation is only if you receive without consideration or for inadequate consideration. If you are receiving it in consideration, say for example, I have rendered some services, some professional services for which I am receiving this VDAs, then it is not without consideration. Whether it is for inadequate consideration, little challenging, because unless you do the comparative valuation of my professional services with the value of VDAs, you will not be able to say whether it is adequate or inadequate. But otherwise, if I'm getting conceptually or principally, if I'm being rendering services for which I get a compensation in form of bitcoins, then it is not coming under gift taxation. But I have to, in any case, pay the tax as per the normal rate. So if it's my professional fees, I will always pay the normal tax rates on that. Here the challenge will be on the valuation of those VDAs. Okay, so we have discussed, I think we have spent some lot of time on VDAs, because that was a new principle or the new concept which was coming through this finance bill. So let us now move over to some of the other, what we can call a routine amendments, or the amendments which are meant for overruling some of the court decisions. So first is the favorite 14A disallowance. Here the controversy was that whether if you don't have an exempt income in a particular year, whether 14A can still apply. So you had the special bench ruling in case of Cheminvest in 2009 and the CBDT circular in 2014, which took the view that disallowance will apply even if you don't have an exempt income. Then there were a series of high court rulings, including the Cheminvest ruling itself, which was special bench was overturned by the Delhi High Court, which held the view that this disallowance will not happen if there is no exempt income earned in a particular year. The key point over there was the ratio of Rajendra Prasad Modi. Now, according to that ratio, you don't need an income to claim a deduction. So if you apply it logically, then disallowance can also trigger if you don't have an income, because you're getting a deduction of an expense. However, this ratio was distinguished by the Delhi High Court in Cheminvest Limited. Thereafter, in the tax departments, SLPs have been rejected in quite a few High Court rulings. There is some bit of controversy whether it was merely a dismissal of SLP or whether it was also a ruling on the merits and therefore it becomes a binding precedent, or it's a Supreme Court ruling on merits. So there's some amount of gray area on that. However, now what the amendment proposes to do is, to address that controversy to the favor of the tax department. Now, what it proposes to insert, this finance bill proposes to insert a new explanation, which says that notwithstanding anything to the contrary contained in the Income Tax Act, Section 14A shall apply and shall be deemed to have always applied. So we have this difficulty with this language, shall be deemed to have always applied, in a case where exempt income has accrued, arisen, received during the previous year, and the expenditure has been incurred during the said previous year in relation to such exempt income. So this is one part of the amendment which tries to say that it will, even if the exempt income has not accrued, arisen, or received, 14A disallowance will still happen, notwithstanding anything to the contrary containing any other provision of this act. There is another amendment, if the controversy is not getting addressed because of this, they have inserted another non-obstante clause in 14A1 itself. Now, before 14A1, it is now the phrase will be added, notwithstanding anything to the contrary contained in this act. So whether addition of this phrase in 14A1 is covering some different type of controversy also, or it is meant to address only this absence of exempt income controversy, is something which we'll have to see in practice. But practically, it will be, because this 14A has now become diluted after the dividend income has become taxable. So therefore, we may see very less practical application now onwards. Now, there will be some difficulty with the words used, shall be deemed to have always applied, and the applicable date being assessment year 22-23. Next slide, please. So it is applicable from 1st April 22. So in a sense, it is retrospective because it also applies to the current financial year. Though the government might say this amendment is prospective, but the language is so worded as if it is clarifying the law retrospectively. So, shall be deemed to have always included. That's a very particular feature of all the amendments which are being carried out since last 1 or 2 years in order to override the court rulings. However, in earlier cases like indirect transfer or royalty related amendments, courts have taken the view that these are not retrospective, these will be prospective. In corporate cases, they have taken a view. Now here what happens is, courts will now have to resolve whether this newly inserted explanation will apply on a prospective basis. And the main reason why they use this language and make it prospective is that you have to simply compare if this shall be deemed, this wording is not there for removal of doubts, or shall be deemed to have always included is not there, and they make it only a simple plain vanilla prospective amendment, then all whatever are the cases which are pending in litigation will immediately go in favor of the taxpayer, because the taxpayer simply has to say that look, the law has changed from a prospective date. So in order to save the past cases in litigation, the wording language is used is such that the court will now have to decide whether it is retrospective or prospective. In this 14A, the amendment is only suggesting that the absence of exempt income will not prevent the disallowance. There is no amendment to the rest of the sections on 14A2, 3, Rule 8D, etc. So it's always possible for the taxpayer to say, to prove that there has been no expenditure incurred for earning a particular income, and therefore there should be no disallowance. That will be on facts, not on the basis of an argument that in absence of exempt income, there is no disallowance. 14A1, because the dividend income has now become taxable, so it may have very limited practical application. The only dividend income, which you can see is still tax-free today, is something which you get from the REITs, where the underlying the companies, if they have not opted for this 115BAA removal rate of tax, then that particular stream of dividend income is exempt in the hands of the unit holder. So this amendment might affect those type of incomes. Or if there are any other incomes, like there would be some income from interest-free securities or something like that, for which this amendment may apply on a prospective basis. Next slide, please. Explanation 3 to 37.1, perquisites. This is again one controversial topic which is sought to be addressed through this finance bill. Section 37.1, as you all know, deals with expenditure which is laid out or expended wholly and exclusively for the purpose of business. And there's an explanation 1 which says, but this will not include expenditure incurred for any purpose which is an offense or which is prohibited by law. Now, disputes arose basically in the pharma sector with regard to the providing various freebies to the doctors. And that controversy has been explained in detail in the explanatory memorandum. At least 6 pages have been devoted just to explain the developments. So it all started with the MCI guidelines, which said that, Medical Council of India guidelines, which prohibited the doctors from accepting certain gifts or hospitalities from the pharma companies. So then Tax Department came out with the circular 5 of 2012 and said that if such freebies are given by the pharma company, it will be hit by explanation to 37.1. And the validity of this circular was upheld by the Himachal Pradesh High Court. Thereafter, there are decisions on both the sides, some in favor of the taxpayer and some against the taxpayer. So the favorable decisions took note of what were the nature of gifts involved, which are low cost gifts, clinical stationery to doctors with company logo, free samples, etc., etc. They have taken a favorable view. In contra, you have unethical expenses such as referral fees, commission to prescribe medicines, commission by diagnostic center to refer the patients, sponsorship of personal vacations. So all those kind of extreme cases were there that the courts have taken a negative. But in between that, one legal argument which was taken by the taxpayer and which was accepted by some of the tribunals was that these regulations, Medical Council of India regulations, applied only to the doctors and not to the pharma company. So they apply only to the payees and not the payers. And therefore, explanation 1 will not apply to the pharma company, which is the payer. Now, this argument was accepted by some of the tribunals, and that is the why reason you have an amendment. The second aspect of the controversy was that when explanation 1 talks about law, it does not clarify whether it is Indian law or foreign law. And therefore, some courts took a view that it only includes Indian law and not a foreign law. So one example is the Hyderabad Tribunal ruling in case of Myland Laboratories, where the payment, where there is a non-compete agreement which the Indian company entered into with a foreign company, and it received certain fees. Thereafter, the EU, under the anti-competition law, it was held to be infringing that law, and thereby the Indian company had to refund it or pay it back to the regulator. First controversy was whether it was a penalty or whether it was compensatory. That was one. There, the tribunal came to a view that this is a penalty, fine. It is otherwise disallowable under explanation to 37.1. But the taxpayer raised an argument that this is, if at all, it's an infringement of the EU law, not the Indian law. And there, the tribunal agreed with the taxpayer and they allowed the deduction. So this is the second angle which is sought to be addressed. So the explanatory memorandum clearly, explains all this rationale. But what the disturbing feature of this explanatory memorandum is saying that, the legal position is clear that any expense which is incurred for providing benefits in violation of regulations is not allowable, and the favorable decisions are clearly not in line with the legislative intent. And therefore, to make the proposed amendment, to make the legislative intent clear and free from any misrepresentation, we are making this amendment. So it is sort of casting, doubts, aspersions on the interpretation given by the various high court, maybe high court or the tribunal rulings. They are wrong, and we want to make it correction. But they are doing their constitutional duty of interpreting the law. If you have the government has a problem with the interpretation, they can always amend the law. That power is always available to them. But to make any statements that the interpretation is not in line, it's not correct, etc., is something I would feel very strong and very aggressive in the statements in the explanatory memorandum. Nevertheless, we come to what is the amendment. So now we have a new explanation 3, which will take effect from assessment year 22-23. But again, here also the phrases used are, it is for removal of doubts, and it shall be deemed to have always included. Again, the same controversy, whether retrospective or prospective. Now, what is the amendment? Now, not new explanation 3 says it is divided into 3 limbs. It says explanation 1 will include the and shall be deemed to have always included any expenditure incurred by the taxpayer, 1, for any purpose which is an offense under Indian law or a law outside India, foreign law. Second is expenditure incurred to provide any benefit or perquisite in whatever form to a person, whether or not carrying on a business or exercising a profession, and the acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guideline. And the third is to compound an offense under any law for the time being in force in India or outside India. So 1, India law versus Indian law versus foreign law. Second is benefits which are given in violation of any rule, regulation, guidelines, etc. Next slide, please. This amendment arguably is prospective, but now in ongoing litigations, court may need to take a notice and then decide whether it is prospective or retrospective, because there are quite a number of negative decisions also, which have said these expenses are against the public policy. So the courts going through a tilting towards that view, they may say this is more of a clarificatory amendment. So here it's not so clear-cut position as for, like, let's say for 14A1. Now it impacts 3 types of expenses which are in violation of foreign law, which are prohibited for the recipients, and the compounding fees which are paid under Indian or the foreign law. What we have to remember is it is not restricted merely to pharma sector. It can apply to any sector. It is not restricted to payments only to businessmen or doctors or professionals. It applies to employees also. So in a hospital, you can have consultant doctors, you can employ doctors. If you make payment to any of them in violation of these MCI guidelines, it will be disallowed. Third is under the second limb, it is not merely mentioned law. It also talks about rules, regulations, or guidelines. And this creates an ambiguity. Why this expanded scope? Because of this, because of this expanded scope, whether if there is any internal guideline which prevents the taxpayer from of the particular individual, etc., from accepting certain gifts, whether the payer is also supposed to know that there are some internal guidelines, governing the conduct of such person, and therefore this payment will get disallowed. Now that is a very difficult area and very difficult to implement. The moot point which arises is who decides whether there is an infringement has happened or not? Is the income tax officer, assessing officer, or the income tax department the right person, the right authority to decide whether there's an infringement of a medical law, insurance law, securities law, foreign law, etc.? Who has to decide? It is that particular regulator who is regulating that particular business has to decide whether there is a violation, and if that becomes final, then only the income tax officer can act upon it. So we have examples in case of insurance industry, in case of reinsurance premium, or surrogate advertising in liquor industry, where they have held that it is not for the AO to say, if there is no action has been taken by the regulator, then it is not for the AO to say this explanation 1 to section 37 will hit trigger and the expense will be disallowed. The next point is the distinction between compensatory and penal nature of the expense is still intact. I feel that is still intact. For example, if you have defaulted on a loan installment and because of which you have to pay some penal interest, or if you have not furnished certain stock statements in time for which certain penalties are levied by the bank, these are all contractual or compensatory payments. They will not be covered under explanation 1. The third link about compounding fees creates some ambiguity for the out-of-court settlements, where the settlements are made without admitting any guilt by any of the parties. So whether that is for compounding an offense, first an offense has to be established. Whether without establishing an offense, if you settle it outside the court, whether it will still get covered by compounding is something which needs to be seen. Now, in terms of reporting, there will be now additional obligation on the taxpayer as also on the tax auditor to verify whether now the expenditure gets hit by the expanded coverage of this explanation. The initial burden will be always within the taxpayer, and once the taxpayer has discharges on us, then the burden will shift to the AO. Now, because now it is expanded, and now the payer not needs to look from the payee's perspective also. This becomes a corporate governance issue for the entire industry. Now they have to change their practices or modulate their practices to see that whatever payments they are made, they are compliant not only with the regulations which impact them, but also the regulations which impact the payees. Okay, now combined with that is a TDS provision, which is talking about TDS on the benefit or perquisite of a business or profession. So 28(4) was already there in the statute since 1964, but there was no tracking mechanism for getting this information. So therefore, now you have a new TDS. Next slide, please. Very briefly, what type of payment is covered by this new TDS? It comes into effect from 1st of July 22. It covers the benefit or perquisite, whether convertible into money or not. The rate of TDS is 10%. Again, it's a domestic TDS payable to residents, so therefore no surcharge cess. Here, there is no possibility to avail any lower or nil withholding certificate. The amount on which tax is to be deducted, if the value exceeds 20,000 rupees, then this TDS applies. But this is a benefit in kind. So therefore, unless certain valuation rules are prescribed, it will be very difficult to implement this provision. This benefit or perquisite, what we have discussed under the earlier part of our explanation to 37, it could be legal or illegal, right? That it covers illegal benefits, but for as far as TDS is concerned, it could be both legal or was illegal. It will be covered by the TDS. The person who is obligated to withhold is the person who is responsible for providing the benefit. It's a specific definition which is provided. Again, here, non-residents, we can say if they don't have taxable presence in India, they will not have the TDS obligation. Next slide, please. Now, one particular issue will come that if you are knowing the identity of the person, then you can do the TDS. Only then you can do the TDS. Now, in this case, many of the gifts are offered to the dealers, agents, etc., where the recipient is a legal entity, but the actual gift is enjoyed by an individual. So he could be the director of the dealer, he could be a partner of the dealer. The dealer could be an LLP, and the person who is enjoying that particular gift, which is say, let's say TV or motor car, or let's say foreign tour, etc., could be an individual. So then the TDS is to be done in whose name, the dealer's name or the individual's name? That could become a very tricky issue. Next is about expense disallowance. We all know 40A1A, if there is a TDS default, there is an expense disallowance. But the issue over here would be that on the payments, underlying payments, let's say you have chartered a flight, you will deduct 194C. You have engaged some professional artist, so you may deduct under 194G. But that all those payments are resulting in a benefit to the pay. Some other, it could be dealers, agents, and also. Now, if you don't do TDS, whether this disallowance under 40A1A can apply or not. Because otherwise you have done the proper TDS on the underlying payment. What you have not done the TDS is on the gifts, this expenditure which results in a perquisite or benefit to the recipient. Now there it might be too aggressive to take a view that 40A1A only covers some payable, only the money payable, whereas this is in kind, and therefore the disallowance should not apply, is something which I feel will be too aggressive an argument to take. Now, date of applicability, there is some confusion because in the bill, if you read the bill, it is coming 1st April 22, but in the explanatory memorandum, it is coming 1st of July 22, but there is a corrigendum to the finance bill, which says that, in the bill, it should be read as if it is 1st July 22. So it will become effective from 1st July 22. Now, these are benefits payments in kind. So therefore, you have provision that if you have to do TDS before you release the winnings, just like lottery winnings. Coming to the issues, there will be a lot of difficulties, practical difficulties for implementing this provision. First is there is no valuation rule. So how will you value the benefit? Whether you take cost to the employer, cost to the company, whether you take fair value in the hands of the payee. If you refer to the circular which had explained this 28(4) insertion, they had given an example of a rent-free residential accommodation provided to the lawyer. So now how will you now value it, whether under the current salary valuation rules, it is percentage of salary. So do you take percentage of the professional fees paid? It will become very difficult. Second most important point is the distinction between a bona fide business expense and a personal benefit. I have given a lot of examples on the slide. These are all bona fide business expenses, not intended to give any personal benefit to the payee, but in order for you to do a sales promotion, and it's in purely in the business nature. So in this case, for example, a sales conference is there. Now you may take the dealers to a resort, but if you spend majority of the day discussing your business, new business strategy, new products, and only the small part of it is spent in leisure activity, do you say that the whole expenditure results in a benefit or perquisite, and you're required to do TDS on the whole of the amount? Then possibly nobody will attend your dealers conferences. So dealer conferences, agent conferences will never happen if this TDS is to be applied. Second part is that some of the benefits are already getting taxed. So for example, if an interest-free loan you are giving to your dealer, then he's not paying interest. So his P&L does not have the debit of the, he's not claiming any interest deduction. Right? Now, if you do a TDS and if you say this is an income, then whether you will give a corresponding deduction or not, that also becomes a very challenging issue. And the last issue is that the payer may take a view that it is, he may wants to be very conservative in case of TDS, and he says, I will deduct the tax. But the payee wants to take a view that this is not a benefit or perquisite, and I don't want to pay tax on this. Now, and therefore, he does not pay the tax. Now, is he entitled to take the TDS credit without offering the corresponding income to tax? That will be the difficulty, whether he will face challenges when his return is getting processed, because there will be a mismatch between his Form 26AS and the return. So it will create a lot of problems for the industry. So this particular provision will have a lot of implementation problems. Next, please. Okay. Conversion of interest into debentures. I will quickly rush through this because I am dealing Praful by. I have already overshot my time. 43B, as you know, all are aware, talks about deduction on your actual payment. So interest payable to bank or financial institutions, you get the deduction only if you are actually paying it. Now there is a controversy about the explanations 3C, 3CA, 3D, which provide that if you are converting an interest into loan or advance, then you will not get the deduction. And there is a Supreme Court decision which said that in a particular case where outstanding interest was converted into debentures and both the parties acknowledged it, that because of this conversion, the liability to pay has got extinguished, and the lender had also offered that income to tax in his own return, then there is no abuse of 43B in this case, and therefore these explanations will not apply. It is an actual payment and you will get the deduction. Now, in order to overcome that Supreme Court ruling, now what is provided is, if the interest is converted into debenture or any other instrument by which the liability to pay is deferred to a future date, then it shall not be deemed to have been actually paid. So if it's converted into loan and advance, it is not be regarded as actually paid. Now, even if it is converted into debenture or any other instrument, it will not, disallowance will apply. And fortunately, next slide, please. Very fortunately, this amendment is having a prospective effect from assessment year 23-24, possibly because now they are respecting this issue has been resolved by the Supreme Court decision. Though the explanatory memorandum still says some courts were taking an incorrect view, but they are respecting the Supreme Court ruling and making it truly prospective. Now the issue is that if the lender has already offered the interest income to tax, there is no abuse of 43B, whether that argument now becomes academic because of this amendment. Another thing is, if not converted into debentures, but if it is converted into some other instrument like equity shares or preference shares, where the liability to pay itself gets extinguished, there will be no further payment on that equity shares, or rather the shareholders are not considered as creditors of the company. So therefore, there is no liability to pay. The liability is not deferred, the liability is extinguished. Then in that case, whether this amendment will apply, there is an arguable case to say that once it is converted into equity or preference shares, the liability stands extinguished. It is not a deferred liability, and therefore deduction should still be the allowable. But the other side of the amendment is that now it allows a scope for planning, that even when you have to restructure a debt or something, now this will postpone the deduction. So therefore, if you are postponing the deduction, the losses will also get postponed, and section 79 will also not apply for the intervening, restructuring of shareholding, etc. So there is a silver lining to this particular amendment, which it can help in some debt restructuring arrangements. So with that, I'll hand over it to Praful Bhai.
In fact, the flow of Ravikanth was so lucid and so explanatory that I'm feeling that I'm unnecessarily coming in his way and completing the balanced budget slide. I would have loved him to complete it, but yes, let me also try to cover up some of the other amendments. And the Ketan here, I think most of the amendments which I am dealing are of less conceptual nature, and there are more of routine things which normally the finance bill would carry it out on that. The first one is on the ongoing controversy, and we all are aware that on the deduction of the education cess, we have Rajasthan and Bombay High Court rulings and few of the tribunals thereafter, where they have allowed the cess as a deduction while computing the total income. But recently, I think Kolkata Tribunal took a different view. Kolkata Tribunal relied upon one Supreme Court ruling in S. Srinivas case to take a view that education cess represents tax under the Income Tax Act, and hence it is not allowable. The Kolkata Tribunal preferred to follow the Supreme Court ruling as against the High Court rulings on the subject. Now, what budget 22 now proposes is to clarify that the cess shall not be allowed as a deduction. And the explanatory memorandum suggests that this is to neutralize the High Court rulings, and the view is in line with the Supreme Court ruling. So they want to synchronize the view with the Supreme Court ruling in the matter. And the amendment is made with retrospective effect from 1st April 2005, when the education cess was first introduced. Now, what is the effect of this amendment? Naturally, the taxpayer is likely to suffer disallowance in ongoing assessments as also in ongoing appeals. Courts and tribunals are likely to respect the amendment, and they will decide the issue against the taxpayer. There is also likely to be, initiation of the proceedings for either rectification under Section 154 or revision under Section 263, or even reopening under Section 147 within the applicable limitation period, and those disallowances are therefore expected in the days to come. Now, the issue or the concern which taxpayer may have about the interest levy and penalty levy as a result of disallowance, and this disallowance is happening on account of the retrospective amendment. Now, it is clear that there can be no additional tax payment if claim for the deduction was made after payment of tax, and such appears to be the larger scenario, where I think in many of the cases claim for deduction was made either during the ongoing assessment or during the appeal proceedings by raising additional claim or by raising additional grounds of appeal. If such be the case, then I think perhaps taxes would have already been paid earlier while filing the return of income, and therefore there could be possibly no additional tax liability, unless of course refund so claim has already been allowed to the taxpayer on account of the deduction being allowed by virtue of the court rulings. But for that there is unlikely to be any additional tax becoming payable if already paid by the taxpayer. As regards the interest levy and the options available with the taxpayer, generally interest is consequential to the payment of the principal tax amount. However, if this interest levy happen to be on account of the retrospective amendment, taxpayer as one option can opt for the waiver of the interest pursuant to the CBDT order of 2006. Alternatively or additionally, taxpayer may also explore a possibility of challenging the interest levy in the appeal, in the ongoing appeal, on the ground of retrospective amendment being not in contemplation while estimating the advance tax liability, and or on the ground of impossibility of performance. So we believe that the interest levy could be defensible in the facts of this case, having regard to the retrospective amendment. Similarly, the penalty also could be defensible penalty could be defensible on account of, again, the same reason, that it is due to the retrospective amendment, and you cannot penalize a person by penalty if the amendment is retrospective. Secondly, there is a possibility to say or suggest that the claim was a legal claim, which is supported by the High Court and ITAT rulings, and hence also the claim should be defensible. Thirdly, and I think in most of the cases, it was definitely a bona fide claim which was made. And if the taxpayer has made the claim after disclosing the facts of the case, so even under section 270A, subsection 6, the claim could be defensible, penalty could be defensible. For the similar reason, even prosecution can also be defensible. So as a practical aspect, perhaps, whatever the way forward for the taxpayer should be that for all those past years where claim is either pending in the assessment or in the ongoing assessment, it is better that we withdraw the claim. And if any shortfall in the taxes, if any are there, it is deposited at the earliest, so as to, number one, respect the retrospective amendment, and number two, to avoid a possible interest levy, and thereby try to mild down the claim for the waiver of interest, etc. This takes us to the next amendment, and where Ketan Bhai also mentioned about amendment to section 68 and the implications thereof. We are now likely to go back to the old practice. I think when I started my career in the profession, in the practice, at that point in time, section 68 was very much in limelight. I'm talking about year around 1992. So there, the section 80 additions were very much in limelight, and virtually each of the assessment order, you will find one or the other additions under section 68. And this is how the practice, or the knowledge in that section has grown at the very initial stage of my days. Now, we all are aware here that today the taxpayer is to explain mere source of the borrowing by establishing identity and capacity of the lender and genuineness of the transaction. Now, what the finance bill proposes to provide is to cast an additional burden on the taxpayer to also explain source of the source in the hands of the lender. Presently, and it means it is not a new thing so far as the closely held companies are concerned. We are aware that in the case of the closely held company, in relation to the receipt of the share capital or share premium, etc., from a resident shareholder, such an obligation is there to explain source of the source, but then it was within the close group of company and the shareholder. There is an exclusion provided for the regulated entities being SEBI registered venture capital fund and venture capital companies. Now, unlike closely held company, the proposed amendment will apply to every taxpayer borrower, including non-resident or LLP or companies. All the entities will now be subjected to the onerous test of explaining source of the source in respect of any of the borrowings. And secondly, it applies to every lender, excluding, of course, VCF and VCC, whether lender is resident or non-resident, or whether lender is a banking company or financial institution. In all of them will be subject to this onerous obligation when a person is receiving a loan from such entities. Now, scope coverage, as amendment itself suggests, is very wide. Technically, as we discussed in respect of bank loan obtained by the taxpayer, technically such taxpayer is required to establish source of the funds from which bank has lent the amount. Likewise, if the bank were to receive or accept the deposits from the depositors, bank's depositor in the normal course of the business, bank may also be exposed to such onerous obligation. So everything gets covered now, whether it is ECB loans or overseas borrowings by issuers of Forex or rupee bonds, whatever may be the thing. So loans, borrowings, or similar, any such similar amount will be now exposed to this onerous obligation. Now, impact could be multifold, in the sense that if A lends money to B, and A is unable to explain source in his hands, the addition can be made not only in the hands of the A, but also in the hands of the B. So the same item of amount is likely to get taxed in the hands of A and B both. And if we extend the example further, that B refunds the loan to A, which then in turn was given to C or lent to C. And if A is not able to explain the source of income or source of the income from which the amount was lent originally to B and thereafter to C, theoretically addition can be made in each of these parties, and therefore the same amount may come up for multiple taxation. It may be remembered that any income which is assessed under Section 68 is liable to tax at the accelerated rate. The tax rate is 60%, the surcharge is 25%, which will make the tax rate 75%. With 3%, education says it will be 78%, and penalty of 10%. So this is the likely impact of the addition under Section 68, and we can just assume the likely fate of the taxpayer in the real life scenario, where it will be practically challenging for any borrower to get the details of the lender. And considering the issue of confidentiality of the personal data, lenders also will not be cooperating in such scenario. And if the tax rate is as high as 78%, we can just envisage a scenario how tough will be the life of the taxpayer if any addition is proposed under Section 68. This takes us to the subject of updated return. It's an interesting subject, and let us have a quick look at that. And I will take little time to explain you the new topic and the scope of the new topic, and to what extent it is likely to be beneficial or it is likely to be not so beneficial. Now, the finance bill, by way of a facility, proposes to provide for filing of an updated return by the taxpayer to cover up any omission or mistake in correctly filing the return of income earlier. The explanatory memorandum acknowledges that the time limit for filing revised or belated return is very tight, and considering that the tax department is in possession of the used data and information, one more opportunity is to be given to the taxpayer for voluntary compliance to cover up omissions, if any. Now, what is the proposal? Proposal is as under, that subject to certain exceptions for disqualification, any person can file an updated return on or after 1st April 22 at any time within 24 months from the end of the relevant assessment year. But such filing would be subject to payment of an additional tax, which could be 25% of 25% if the ROI is filed within 12 months, or it could be 50% if the return is filed within 24 months from the end of the relevant assessment year. Further, the updated return can be filed even if there is no filing of original return. You have not filed any original return, and yet you can file the updated return. And effectively, therefore, if no disqualifications to apply, then taxpayer has a longer period to file ROI, but of course with an additional cost to which we will touch upon the issue little later. Like other provisions, here also CBDT is given power to remove difficulties in case if at the stage of implementation, such difficulties were to come up. And there are certain consequential amendments are made to the procedural provisions, and the one of them is in respect of granting immunity to the taxpayer from prosecution. That is very welcome amendment, and that we will touch upon when we are dealing with certain other aspects. Now, these slides enlist certain disqualifications where taxpayer cannot file the updated return, and law provides for the 4 categories of disqualification. Firstly, it says that the CBDT can notify some class of taxpayers who cannot file updated return. Now, what is that class of taxpayer presently is not known. We have to wait for the CBDT's notification, whereby the taxpayer itself is completely debarred to avail the benefit of the facility of updated return. Second disqualification is attached to the updated return itself. It says that loss return cannot be filed, in the sense that in updated return, if due to offering of any additional income, if there is a reduction in the loss, but the net result is still a loss, then such loss return cannot be filed. It also provides that if the result of updated return is decrease in the tax liability as compared to the original or revised return filed by the taxpayer earlier, then such cases will not qualify. So it therefore indirectly suggests that there has to be some additions to the total income declared earlier, then only you are entitled to file the return, file the updated return. It also, the other two segments are nothing but the subsets of the earlier segment, that when it results into refund, namely that originally there was a tax payable, but because of the updated return filed, if it results into the refund, or originally it was a refund case, but due to updated return, if it increases the refund, then these two scenarios are also not to permit you to file the updated return. So these disqualifications are attached to the updated return. Then the next disqualification is in respect of a given assessment year for which the updated return is proposed. There are 4 situations or scenarios provided therein. Firstly, if you have already filed the return, updated return earlier, then such updated return cannot be filed second time. It is only once for the given year. You are not permitted to update the updated return. Secondly, where any proceedings for the assessment or reassessment or computation is pending or has been completed, in either scenario, taxpayer is debarred for that assessment year to come to updated returns facility. He cannot avail the benefit of the updated return facility in such case. We will come to that some legal issue arising out of that little later. The next disqualification is in respect of the information which AO is in possession and has been communicated to the taxpayer prior to filing of the updated return, then the person will disqualify. What is that information? Then any information received by the assessing officer under the specified acts of Benami property or money laundering or BMA, etc., and information received under section 90 or 90A from the foreign jurisdiction. So if this information is in possession of the AO and AO has already communicated to the taxpayer, then for that year, the taxpayer will be debarred from availing the benefit of updated return in this case. And lastly, where the prosecution under ITA has been initiated and taxpayer is informed about that prior to the filing of updated return, then in that case, taxpayer will disqualify himself for that assessment year. And lastly is in respect of disqualification in respect of search and survey cases, where not only the year of search, but even the preceding two assessments here are debarred from availing the benefit under updated return. Now this slide carries some methodology as to how the additional tax will get determined under updated return. This is a very broad structure, and one will have to one will have to go through the provisions very minutely before you envisage any computation under this regime. On mota, effectively, the tax is on the incremental returned income offered under the updated return facility. So you have to work out the tax, you have to work out the surcharge, and you have to also work out interest under ABC, and whatever the net result which comes up under the normal course of your computation, that will become your base. While working out the tax payable and the interest liability, refund issued in respect of any earlier return under 143.1 or under 143.1 is required to be added back to work out the net tax liability arising out of the computation, out of the revised computation under the updated return. So vis-a-vis this total, that the additional tax will get worked out. So in our slide, the total of ABC, which is total, is defined as E, that is aggregation of A plus B plus C plus D, will be the basis on which the additional tax will be computed. If the updated return is filed within 12 months from the end of the relevant assessment year, it will be 25% of E. If it is after 12 months, but before 24 months, it will be 50% of E. And having additional tax having so computed, thereafter will not be further, be made liable for any interest under 234A or B. It will be the final amount which will be determined for payable as an additional tax under the scheme. Now, let us consider broadly how the working is likely to happen and what are the issues which one will have to bear in mind while determining the computation under the two different scenarios. We have a scenario 1 where original return is filed, scenario 2 where original return is not filed. And we are told that in the original return for assessment year, say assessment year 22-23, your income disclosed in the original return was 1,000, taxes paid by way of an advance tax, say 300, and thereafter, on account of any information available or reflected in 26 AS, etc., it appears that there was some omission which was discovered, which is amounting to rupees 500. Now, if such person were to file updated return in December 2023, how the computation will happen? And we are presuming that all the disqualifications which we discussed will not be applicable in this case, and taxpayer is perfectly entitled to file the updated return. Now here, if we go by scenario 1, the incremental income will be 500, incremental tax payable at 30% assumed rate will be 150. Interest under 234A will not be applicable because original return was in time. Interest under section 234B, if at all, will be worked only with respect to the 150, the additional tax liability which is arising, and that too from April 22, that is the big 23 when the taxes are paid. So on 234B interest only on the incremental tax liability that will be worked out, and interest under 234C also will apply because it is with respect to the returned income, and returned income will now have an additional income of 500, resulting into additional tax of 150, and therefore 234C exposure will be there with respect to 150. We will come to penalty and prosecution little later. Now, as compared to scenario 1, as compared to scenario 1, in scenario 2, whole of the income of 1,500 will become and incremental income. Because you have not filed the original return, so even your normal income of 1,000 will be considered for updated return as the escaped income, so to say, or omitted income, so to say. So all the consequences of tax and interest will be with reference to the amount of 1,500. So therefore, incremental tax is 450, that is 30% of 1,500. Interest under 234A will apply here, because original return was not filed. So it will apply with respect to 450 from August till December 23. 234B will also accordingly apply with respect to 450 from April 22 to December 23, and 234C will be with respect to 450. So there will be, therefore, the taxpayer who is not filing the regular return and is opting for the updated return will be exposed to the incremental tax liabilities and interest and additional tax liability also of 25 or 50% as the case may be, with respect to the entirety of the income which is reported under the updated return. So that is that factor one will have to bear in mind. Now, so far as the penalty is concerned, since the income is getting reported in the original or the updated return, penalty under 270A should not apply, having regard to the mechanics provided under 270A. In any case, I think the government officials in the public meeting have indicated that they will come out with the clarification that no penalty should be leviable in case of a return offered under the updated return. Prosecution under 276CC for non-filing of return of income, there is a specific amendment made in 276CC to clarify that any return filed under the updated return scheme will not expose to the prosecution in respect of the failure to file the original return earlier. So that backup provision is available. And thirdly, and lastly, rather, the prosecution under 276C, that is for tax evasion. Can there be a suggestion that the additional income offered in the updated return represents the tax evasion attempt made by the taxpayer while filing the original return? There is no clarity available. And therefore, where the in the scenario one, therefore there could be some debatable issue whether or not prosecution can be launched. But in case of scenario two, since there was no evasion earlier, since the income is already offered in the updated return, there can be no question of any evasion being tax evasion being attempted in that case. So to that extent, there seems to be arguable case that no prosecution under 276 can be launched in scenario 2 cases. Now, while whether to file the updated return or allow the reassessment to be done on the basis of the information, which of the option would be more appropriate is a very highly fact sensitive exercise, and one will have to determine the aspect or evaluate the options after very thorough examination of the pros and cons of each of the regime that taxpayer proposes to adopt for that. But broadly, mota, what are the points for considerations? The considerations which supports filing of updated return would be that it avoids 234B interest. The avoidance of the interest will be beyond the period of filing of ROI till the date of completion of reassessment, which generally involves a time limit for completing the assessment. So the additional period can be protected. Interest liability for additional period can be protected. It avoids the exposure of penalty and prosecution. Now, subject to small clarification on 276C, if you are getting the relief under penalty, you are getting the relief under the prosecution, then it is one big advantage that one will have to bear in mind, and particularly having regard to the litigation that can go a long way in any such sensitive matters. Then unlike in the reassessment regime, in the updated return filing facility, it is possible to contain that any relief which was unrelated to the escaped income and which was missed out in the original return, you can certainly claim that relief while filing the updated return. The only requirement here would be that net of relief, your additional income should be projected in the updated return. It should be little more than the originally offered income, originally reported income, no matter whether the additional income gets offset due to some relief which was remained to be taken up in the original return. Technically, that relief can be claimed in the updated return. Likewise, in case of reassessment, there is always a fear that the scope of reassessment may get extended beyond the escaped income. An officer has power to also initiate, and cover up in the assessment the other unrelated issue, but that thing can be settled down if income is offered under the updated return and the updated return stands accepted by the department, then that inquiry can be limited to the escaped income. And lastly, it avoids time and cost of litigation. It's again a very, very major advantage that the taxpayer should take into consideration in the existing scenarios. Now, what are the demerits? As we have seen in the earlier slide, 234C will be higher. That interest exposure will be higher because it will also have to include the liability in respect of the tax on the escaped income, and the additional tax levy of 25 to 50%. Industry perceives this to be a very high threshold, and it virtually represents the penalty because you are levying that tax, additional tax, on the aggregate of the tax plus interest. So tax and interest in any case you are paying, and in addition to that 25 to 50% that you are making payment, which is nothing but in the nature of penalty. But nevertheless, I think taxpayer will have to evaluate basis the different considerations which we just discussed, and that is what the taxpayer will have to consider in the facts of his own case. Now, certain issues which are German in this new facility, namely, first, as you are aware that under the Black Monies Act, the foreign income is considered as undisclosed income if same is not reported in return of income filed under 139(1), 4, and 5. Unfortunately, backup amendment appears to have been remained here to include 139(8)(a) as well. Otherwise, any income offered under any foreign income offered under under updated return may still be exposed to the BMA proceedings, which we believe it seems unintended omission, and BMA Act may be corrected perhaps in the due course. Second is the ineligibility which triggers if the prosecution is initiated under ITA. Now the issue here is that whether issuance of the show cause notice itself will result into initiation of proceedings, initiation of the prosecution, so as to debar the taxpayer for that year to avail the benefit of the updated return. Now, if VSV circular is any guide, there the CBDT has taken a view that yes, issuance of SCN amounts to initiation of the proceedings, and therefore it will debar the taxpayer to avail the benefit. Further issue also arises that whether any initiation of proceedings for unrelated topic, like for TDS default, which is wholly unrelated to the income offered under updated return, whether this also will disqualify. I think presently, technical readings suggest that it disqualifies, but one will have to wait for the CBDT for suitable clarifications on that. But if the offense is compounded before the date of filing of updated return, I think the case is arguable that person should qualify for filing updated return. The next issue arises about the the proceedings, something which we just discussed a couple of slides before, that one of the disqualification is that in case if there is an assessment, reassessment or recomputation is either pending or is completed for the given year, then taxpayer gets disqualified for that, and issue arises on the interpretation thereof. Now consider a case where return of income is filed, no intimation is received under 143(1), and time limit for issuance of the notice under 143(2) is not expired. Whether in such case, can there be a suggestion that there is a pendency of the proceedings? Here one may have to bear in mind that there is a Supreme Court ruling in the case of auto and metal engineers, where the court took a view the moment return of income is filed, it results into commencement of the proceedings. If the commencement of proceedings is there, then it can be suggested that the proceedings are pending. Now we will have to just wait for the CBDT to clarify on that, whether such a very broad interpretation is required in the context of updated return, or there is a scope to take a different view of the matter. The second scenario could be where intimation is there under 143(1), it is issued without variation. Whether can it results into that now the recomputation of income is over, and therefore you are out of the facility. The issue will be more prone to a debate where there is an adjustment carried out under 143(1)(a) and the total income is redetermined. Whether such redetermination would amount to a recomputation, and since 143(1) is completed, and therefore whether it will debar the taxpayer from availing the benefit is again an open question. So here we will have to perhaps wait for the CBDT to clarify suitably on each of these issues, so as to make the scheme workable. But certainly in a case where once the time limit of issuance of the notice under 143(2) is expired and no notice is issued, then certainly that will be a case which is neither pending nor completed for the given year, and therefore such case may qualify for filing updated return. Request to participant to just go on mute. Next amendment is something relating to the faceless assessment, and there are certain changes proposed in the finance bill to streamline the process of the faceless assessment, and also to address various legal and procedural issues which have been encountered in implementation of this. And some of the key changes are enlisted here. Need not be an exhaustive one, but some of the key changes are there. And amongst them, the most controversial issue which is getting addressed here is in respect of providing for a specific provision to grant opportunity of personal hearing to the taxpayer upon request. Though such hearing, of course, should be only through the video conferencing, but nevertheless now there is a specific provision made to allow the grant of the personal opportunity to the taxpayer, which was hitherto kept discretionary in the existing provisions. Now they have made a very specific provision to that effect. Secondly, the reassessment proceedings specifically covered, which I think prior to April 21, it was getting addressed through the CBDT order, and now they have specifically provided in the form of a specific provision. The next one, which is very important one, is in respect of NFAC. they have clarified that the role of the NFFC now will be only as a single point of contact among various units, as also with the taxpayer, in the course of conducting the faceless proceedings, and no other function will be undertaken by NFFC. As you are aware that NFFC used to also venture into processing of the draft assessment order, etc. Now that function has been taken away from NFFC, and it is only it is only kept as a coordinating agencies for different connecting different stakeholders in the assessment proceedings. Then various units are now assigned the status of an assessing officer. They were assessing officer, but perhaps I think with a view to avoid any possible interpretational issue, whether the order passed by an assessment unit can be considered as an order of an assessing officer or not, perhaps this clarificatory amendment is proposed. Then RFAC is abolished. Even otherwise also, presently there was no clarity what exact role of RFAC was to be. I think there was some overlapping with NFAC, but it's good that they have removed the RFFC category itself. Now, one more additional steps is factored in the process of undertaking the faceless assessment is to provide for income or loss determination proposal prior to the draft assessment order. So one additional feature or step is involved, whereby officer is to give an opportunity to the taxpayer with income or loss determination proposal. He will means it is as good as providing the draft computation to the taxpayer with whatever additions or disallowances are proposed, and it will be given prior to the draft assessment order. And luckily, and they are made specifically that such proposal for determination can be reviewed only once by the review unit. So if the National Faceless Assessment Center were to believe that having regard to some RMS criteria, risk management criteria, this proposal is required to be reviewed by the reviewing unit, then such review unit can be assigned this work, but such assignment could be only once and cannot be on a repetitive basis. Then 144B9 is omitted with retrospective effect from 1st April 21. As we all are aware that 144B9 provided for the declaration of an assessment order as void if the faceless assessment procedure prescribed is not followed. Hence now, and this amendment is made retrospectively, and therefore one will have to also evaluate the impact of those rulings of the high courts where they have quashed the order as void, having regard to the provisions of 144B9 as then was present. But in any case, if the order is quashed for the reasons of not adhering to the principle of natural justice, then that is in any case is always imbibed in the income tax proceedings, whether or not there is a specific provision. But perhaps the consequence would require to be determined whether order can be considered as a void, as null and void, or order can be considered, or order is just set aside for the procedural lacuna and should be given a second opportunity to the taxpayer to correct the to the tax authority to correct the procedural lapse. So subject to that, I think the principles of natural justice would in any case require to be always observed by the tax authority. This takes us to the another set of amendments in the new reassessment regime. As we all are aware that reassessment regime was completely revamped by Finance Act 2021. The criteria of reasons to believe, which was under the old regime, is now substituted by information with AO, which suggests that the income chargeable to tax has escaped assessment. Now, the present finance bill expands the source of such information with the AO. The table carries the what was the original text of the provisions as enacted by Finance Act 21, and the red liner or the red font suggests what the proposal or what the amendment is proposed by Finance Bill 2022. Here, firstly, the source of information with the AO hitherto was any information flagged in case of a taxpayer in accordance with the risk management strategy formulated from time to time by CBDT. Now, firstly, it is not publicly known what that RMS is, what that risk management strategy is and how it functions. There is no publicly available information about that. Secondly, hitherto only information flagged alone was the basis for AO to initiate the reassessment. Now, the proposal is to remove the flagged. The flagged is omitted. And explanatory memorandum says that it is a correction for inadvertent drafting error. Now, what will be the consequence of that? Consequence would be that all information which is available under RMS will constitute information with the AO to initiate reassessment. And here the issue would arise whether in that case, therefore, the scheme does provide any discretion to the tax authority for identifying the information and to propose for the reassessment. Or if had it been a case of the flagged information, then perhaps the authority would have to make an appropriate steps to reopen the case. But now perhaps it is discretion of the assessing officer whether or not to make use of RMS. But I think one will have to wait and watch how the authorities are reacting to this amendment. The second amendment is in respect of audit objection. And hitherto, the audit objection raised by CNAG alone was to be an information. Now, even the internal audit or preliminary CNG objections may constitute information. Further, now there are three new sources of information which are added. Firstly, any information received from foreign jurisdiction under the agreement under section 1990A. Here, I think the scope is presently not getting cleared in the context of 147 because the assessment of any undisclosed foreign income or asset of a resident taxpayer can be done only under Black Monies Act, and therefore, and not under the Income Tax Act. And therefore, the scope of this information is not very clear. As I said, that not clear in the context of the new regime of 147. But nevertheless, this source now would constitute an information with the AO. The next is that any information requiring action in consequence of tribunal or court order. Now, this is very, very dicey. There is no clarity on whether reference of tribunal or court order is to the tax tribunal or court or any other law tribunal. It is also not clear whether the foreign court order is also to be included here. It is also not clear what is the intent of that. Is the intent to confine it to the legal propositions pronounced in these orders to be applied to the case of the taxpayer or any other purpose also? So there is no clarity whatsoever on the scope and coverage of the order of the tribunal or the court. And therefore, some clarity is required from CBDT on the exact scope of this entry. There is also confusion whether the proposal overlaps with section 150 and 153(6) of the Act, which empowers AO to reopen the case in consequence of or to give effect to the finding or direction of the order of the authority in appeal or revision. Whether it overlaps that, perhaps I believe that it doesn't overlap that, because that was the case where the information directly affects the taxpayer's assessment, and therefore reopening powers are given, that wherever there is a finding or direction given in the assessment of Mr. B, the assessment of Mr. A can be reopened, or in the context of assessment of Mr. A itself, the information or direction may be relevant for reopening the another assessment year. So there appears to be some nexus with the taxpayer, but the scope of this new entry, it is not clear whether it will relate to the taxpayer in that sense by virtue of finding or direction, or it will be a general legal proposition decided by some court on the legal issues, and tax authority will be entitled to apply that principle across the board on all the taxpayers. So exact scope is not very clear to us. The last source of information is any information received in the scheme notified under 135A of Act. Now, what is 135A? It provides for the information collection by the tax authority electronically under different provisions of the Income Tax Act. Presently, there is no visibility on this, as since the scheme is not yet notified. And together with, there is one unfortunate development is that wherever that reassessment regime provides for the procedure for verification and grant of opportunity to the taxpayer prior to the issuance of notice under 148, that facility is unfortunately not extended to this source of information with the AO. Now, one possible reason could be that, which is presently of course not clear, in absence of the scheme being provided, if the scheme itself provides for the opportunity to the taxpayer before initiation of the reassessment proceedings, then that matter may serve the purpose, but one will have to wait and watch what the scheme proposed to be under 135A. This takes us to another set of amendments which proposed to deal with the reopening within the extended period of 10 years. Now, we all are aware that the new regime of reassessment is restricted generally to 3 years from the end of the relevant assessment year. And for 10 years, specified conditions are prescribed. What are those conditions? That AO has in his possession books of accounts, document or evidence which reveals escapement of income of an amount of rupees 50 lakh or more for that year in the form of an asset. Now, to this, there are two amendments which are proposed. Firstly, I will take the bottom amendment noted in the bottom in the red font on the scope of the expanded coverage of the escaped income. And it says that any escaped income which is represented in the form of asset, which was there till financial year, which was there till today. Now, these sources could be expanded in the form of expenditure in respect of a transaction, or escaped income in the form of expenditure in relation to an event or occasion, say marriage function or like, or any entry or entries in the books of accounts, which perhaps reflects the entry for the bogus purchases, bogus expenses, or bogus loan, etc. So the scope is therefore extended to some extent, and there appears to be some overlapping between the new category 1 and 2, expenditure in respect of transaction and expenditure in respect of an event. But nevertheless, if the transaction falls in any of these two, the reopening criteria will trigger. But as it appears, whatever may be the scope of the individual item, perhaps the presence of undisclosed income and possession of the evidence by the AO, at least on a prima facie basis, are must to trigger the extended limitation period. Now, this takes us to another amendment dealing with the threshold limit of 50 lakhs. Sambhav, please turn on this. Yeah. As we discussed earlier, that the amendment has omitted reference to for the year after threshold limit of rupees 50 lakh as provided under section 149(1)(b). Now, before we go to the implications of this amendment, what was the position prior to that? Here, the reopening could be done within a period of 4 to 10 years, that is the extended period, only where escaped income, which is represented by the asset, would be at least rupees 50 lakh for the given year. In case if this threshold is not met for any year, reopening perhaps was not possible. Now, due to omission of reference to for the year, it is possible to suggest that if escaped income is rupees 50 lakh or more in an aggregate over a period of years 4 to 10, reopening may be possible for the given year, even if individually for that year, escaped income is less than 50 lakhs. So this is perhaps the impact of removal of the expressions for that year, which was attached to the threshold limit of 50 lakh. Now, in the new context, in the proposed and read with the proposed amendment expanding the areas of escaped income in the form of book entry, in the form of expenditure, etc., the threshold of 50 lakh is likely to be computed for escaped income under any of these categories individually or in aggregate. So if out of 50 lakhs, if 30 lakhs is in respect of the escaped income representing the asset, another 30 lakh is in respect of the expenditure incurred on an occasion or event, aggregate is exceeding 50 lakh, then year gets covered. Those years gets automatically covered. So that could be another implications for the threshold of 50 lakh. Now, while such appears to be the one possible interpretation of this amendment of omission of the expression for that year, section 149(1)(a), which is newly introduced, creates some ambiguity. The 149(1)(a) proposes to set a limit of 50 lakh qua asset or qua expenditure and allows the AO to reopen every such assessment year in which the investment in asset or expenditure incurred is spread over. So this we will try to understand by a simple example. Suppose taxpayer is found to have acquired, say, unexplained gold jewelry of rupees 60 lakhs. And evidences suggest that the investment was spread over a period of 3 years of rupees 10 lakh, 20 lakh, and 30 lakh respectively. In such case, what section 149(1)(a) provides for? It authorizes AO to reopen each of the 3 years case to tax the undisclosed income, even if qua individual year threshold of 50 lakh is not met, but on aggregate it is meeting. So this is the impact of 149(1)(a). Further, 149(1)(a) overrides the provisions of section 149(1) and particularly for threshold of rupees 50 lakh for reopening within the extended period. Now, ambiguity lies here. Okay, as discussed earlier, the removal of the phrase for that year under section 149(1)(b) has made the threshold of 50 lakh as applicable on cumulative basis across the year 4 to 10. If that be so, it is not clear on the scope of 149(1)(a) and its presence, and the rationale of tagging the threshold to the assets or the expenditure is not very clear, because in any case 149(1)(b) is permitting you to reopen the case the moment threshold on an aggregate basis over a period exceeds 50 lakh, then 149(1)(a) rationale is not becoming clear. Perhaps the only way in which one can put up the thing is that the omission of the expression for that year perhaps is an unintended omission, and it is required to be restored. If it is restored, then possibly one will be able to give meaning to the provisions of section 149(1)(a). Firstly is on TDS on immovable property. We all are aware that 1% TDS is applicable on the consideration paid or payable to the transferor where consideration exceeds 50 lakhs of rupees. And while deducting TDS, no cognizance was taken about the stamp duty valuation at all. Now the new provision is that now TDS will be on higher of the agreement value or stamp duty value. There is no change in the basic threshold of 50 lakhs. Therefore, in a case where agreement value is 90 lakhs and the stamp duty value for that matter is 1 crore of rupees, now the new proposal suggests that the TDS will be with respect to 1 crore of rupees and not restricted to 90 lakhs of rupees. While doing so, unfortunately, 194IA does not take cognizance of the tolerance limit of 10% provided under 50C or 56 to 10. So under ordinary circumstances, in the example given, assessment would still be continued with 90 lakhs in the hands of the seller under 50C. And, because the stamp duty value is within the range of 10%. But for TDS, no such backup amendment is available, possibly perhaps unintended lacuna. It is likely to get covered at the enactment stage. Certain interesting issues may arise, and particularly in case of an installment payments. So in the said example of 90 lakhs and 1 crore, at what stage the deduction should be made for the differential value between stamp duty and the agreement value of 10 lakhs in the example, whether it will be spread over the different installments proportionately, or it has to be considered for TDS only at the last installment is an open issue. Another issue would arise that in respect of an agreement registered prior to 31st of March 22, but some of the installments are falling after 1st April 22. And there is a difference in the stamp duty value, and in the sense that stamp duty value is higher than the agreement value. How and to what extent the rest of the installments will be hit by the new provisions is again an open issue. But whatever may be the case, if the TDS is done on the stamp with respect to the stamp duty value, but because of the the threshold limit of 10 lakhs, tolerance limit of 10%, sorry, the assessment is continued with respect to 90 lakhs in the example, then still the TDS credit will arguably available to such taxpayer to be claimed against the tax liability. This section will have no applicability to the transaction of a pure gift in absence of any consideration being payable for that. This is the last slide for today's discussion, and honestly, it is not very clear the purport of the amendment. Here we are told that 2011A interest at a rate of 1% per month is payable, by the person in accordance with such order. There is no clarity in the explanatory memorandum. What is the intent of that? There is no clarity in the language also. But the CBDT official in the public meeting suggested that the amendment is intended to address an argument that no interest can be levied till TDS is actually paid in absence of the terminal date for levy of interest. So according to that proposal, the interest can be levied and collected only if the terminal date of TDS liability, TDS interest liability is existed, in the sense that only when person deposits the base TDS amount that the interest under 2011A will get triggered, and it is only at that point in time that the interest liability becomes payable. Any intermediary order passed by the assessing officer will not trigger the interest liability, was the proposition which sought to be now overruled by this amendment. I think this perhaps closes for the today's session. We thank you, the organization, and especially to the Ashok Sharma ji, for granting us this opportunity to express our views on the budget proposals. It need not necessarily be reconciled with the views expressed by some of the other professional brothers, but nevertheless, this is what we sought to cover in today's presentation. Thank you very much once again.